All right, so let's go over NIO. It's been a bit since I talked about this on the channel. I used to talk a lot about the trading setups on NIO, but I want to start making this channel a lot more about long-term investing and keeping the other channel, Traders Helping Traders, talking only about trading. It's been a while since we talked about NIO as a company looking at a potential long-term investment. The last time we talked about a long-term investing side was in 2021 when the stock was trading at $53 per share. Now, you can go back and watch that video. Just type in Peter DeCarlo NIO or Traders Helping Traders NIO, or just go into the company breakdown playlist on this channel because there's a lot of them. And we talked about how the company makes money and how I think the company can scale in the future. What I want to do today is talk about the current state of the company, really what the valuation is, if it has fallen enough for me to think about taking a position, and looking at some of the more financial aspects of the company. Hit the like button, subscribe, comment down below any tickers you want me to go over and any stocks you want me to do a deep dive on. I really like doing videos that you guys specifically want, and let's get into it. So taking a look at NIO, very basic. Market cap's 34 billion. It's pretty small, but this is a highly growing company. You're not buying this company at all, or most companies, but really this company at all, for what the current valuation is. You're not buying the company because they're, how to handle money. You're not buying the company because financially it's in a good spot. Like, you're buying the company for massive growth potentially in the future. Now, at this point, market cap is very small, like we said, with $34 billion. Revenue in the past 12 months has been $5.6 billion. Net income has been $1 billion, or loss of $1 billion. PE and 5-year PE are non-applicable because the company loses money. Profit margins is a loss of 20%, which is not good. 5-year profit margin is 64% loss, and gross profit margin over the past trailing 12 months has been 17%. So really bad profit margins, significantly better than what the 5-year profit margin was. So they are getting better. And as we start to break down a little bit more about the company, you'll see that they're still burning money, but at a better rate, at least for now. Price to sales ratio is a 6, which is pretty high. Free cash flow, you can see is minus 319 million. Return on assets is a loss of 7%. Return on equity is a loss of 25%. Return on investing capital is a loss of 6%. And there is no dividend. The other thing that you guys need to notice as well is that this is a very volatile company, right? 52-week high was 44 bucks. 52-week low is 11. So a 75% drop from highs to where we are from highs to those lows. Very volatile company. So if you're going to invest in this company and you believe in it long term, you have to be okay with potentially waking up to see a 75% loss, which is not easy for most people. Now, the first thing I want to look for is growth, right? Obviously, the company's growing. We're just going to talk about that, but I always look for growth. So I want to see a company making more money, not keeping, but making more money in revenue every single year. So 2019, 976 million, 2020, 1.12 billion, and then 2021. This is where they tripled their revenue, and then now almost doubling their revenue. So the company is growing very quickly, which is great. Now, the issue is to grow a company, a tech company, specifically a car company, you have to spend a shitload of money. Like, I'm just going to be honest here. You got to spend a lot of money in order to do something like that. And so you can see that the company is doing better. Let's go scroll up really quick because there are some major things I want you to look at. The company is doing better with money. So in 2019, they did $976 million in revenue, and the net income was $1.6 billion loss. So to scale from 9.7 to 1.12, that's just a smaller, it's like 10% increase. They lost 1.5 billion. So they gained the 10% increase in revenue, and the net income was, $10 billion less, which is good. But now here's one good sign here is that 2021, they tripled their revenue and they only lost 1.2 billion. Now, what would be a massive worry here is if they tripled their revenue and then tripled the amount of money they lost. So if they went, revenue 3 billion and then they had a $2 billion or $3 billion loss. And now looking at 2022, $5.6 billion in revenue, and they've only lost $1 billion. So they're growing quickly and they're still losing a ton of money. But if they can keep at this trajectory, Next year, they could do $9 billion in revenue and only lose, hopefully, $800,000. So they could be profitable in the next 5 years, which is like, if I'm investing in a company, I don't want to see them profitable for that long. But it's probably going to take about 4 or 5 years, I think, for the company to be profitable. But they are on track. Now, looking at the balance sheet, not terrible, like really not terrible, but really not the best. We're just going to look at quickly total assets versus total liabilities. Total assets is 13 billion. Total liabilities is 7.3. So they could pay all of their total liabilities off tomorrow and still have $7 billion, or like $5 billion, I should say, within the bank. So not bad there. It's not like they're super debt heavy. They're still losing money, but it's not like it's super debt heavy. Looking at the 8 pillars, 5-year PE, of course, like we said, 5-year PE, there is no PE, so that's not good. Revenue growth, they're growing massively. That's great. Net income growth, we're not going to have that because the company's not making money. Shares outstanding. This is one thing I would talk about. As of right now, the shares are not diluted, which is good. They're not offering a ton of shares to the public market, diluting shareholders to raise money. It's a very, very good sign. And the cash flow 5-year growth is up. So it's really just, for me, the PE, and the net income. The company's not making money, so we can't even look at those aspects. But I do like that they're not diluting the living shit out of shareholders, which is very good. So let's go through and just kind of look at a price that I'd be buying this company at. And I'll tell you, this is really, really hard, right? Looking at NIO, it's really hard to kind of create some assumptions here. And it reminds me a lot of Tesla 5 years ago, 6 years ago, before the company was making money. Huge growth potential, but if a couple of things go wrong, we're in bad shape. If a couple of things go right, good things, then we're in really good shape. And it kind of reminds me the same way. So we're going to look at just like very, very, very solid conservative numbers. So over the past year, revenue growth is 66%. Let's say that they can do an average revenue growth in the next 10 years of 10, 15, and 20%. You guys might be like, well, no, that's, dude, 1/6, of you're on your low end, and if not 1/3 on your high end. But they're doing 66% revenue. That's true, but they can't do that over the next 10 years, right? Like they're as the company scales, and as any company scales, revenue growth has to slow down. A company like Apple is happy to make 1% revenue growth per year. Profit margins are a loss of 20%. Let's say they can get that under control, and let's just look at a profit margin of 5, 7, 10. Free cash flow is a loss of 5. So let's just say they can do 3, 6. Let's say 5, 7, 10. Let's say 5, 7, 10. We'll keep it there. 5, and let's do 7. Let's do 10. Now, PE ratio, let's do 10. Let's do 15, 20, 25. This thing's probably going to trade at a pretty high PE if they can become profitable. Most tech companies, once they hit that profitability, will trade a little bit higher of a PE. And desired annual return, we're going to do 15%. So we're going to hit analyze, and the numbers you are going to see down here show, and I think I was a little generous on the PE, but whatever, show that basically if you believe that the high end is going to happen, anything under $17 is a good buy. Now, like I said, right now we are currently trading at 21. So judging by, if you think they can do this consistently over the next 10 years, 20% revenue growth, a 10% profit margin. Remember, the company is not even profitable right now. Free cash flow is 10%, PE 25, price of free cash flow 25. You're looking at $17 is where you'd be buying. My middle assumptions, you're looking at 7. Low assumptions, you're looking at $3. Now, when I was buying NIO, and because I was a bull on NIO, and I did own a lot of NIO long term, I actually made close to like 70 grand on NIO. I was buying NIO at like $1.93, right? Because at the time, it was worth the risk. They've done a lot better in the past 2 years since, and it's a little less risky. But to be quite honest, like, I would need this thing. Let's just look at a chart really quick. Like, I would need it back at 10. Like $9 or $10. Like I really would need it back at those prices personally. So for me, I'm not entering right now, but if we get back down to $10, when we were at 12, I should have went in. I'm just gonna be quite honest. I probably should have got some when we were at $13, $12. If we get back down there, I will grab some more. I'll sell some cash secured puts. Let me know what you think in the down in the comment section. Thanks for all the support, guys. Have a great day. Peace.